It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today we've got Rob Sechrist. He's the co-founder and president of Pelorus Equity Group. Rob, thanks for being with us.
Thanks, Josh. Happy to be back.
Appreciate it. So Pelorus Fund, for those that don't know, it's an investment vehicle that makes real estate value-add bridge loans on commercial property with cannabis-related business operators. The fund is secured by first lien real estate loans, has a target net yield of 15% with monthly distributions, and all of the Pelorus Fund investments are conservatively underwritten and vigorously vetted. Not sure many people know what that means, Rob, so why don't you tell us how you got into the game and what that means?
Sure. So Polaris is a value-add bridge lender. That's our expertise. We've done more than 5,000 of those types of transactions for over $1 billion. When we use the word value add in the vernacular for lending, that means a portion of the loan amount is a pre-approved budget to go back into the property to enhance the value, whether that's fix and flip, cosmetic rehabs, ground up construction, tenant improvements, entitlements, whatever it might be. So that's what value add for us is. So we're actually have to underwrite the budget, the property, the as-is value, and the fully stabilized value. But in addition to that, we have to keep working after post-closing other than just collecting the borrower's payments. We have to process draws to go back to put that money back into that property. So that's what we do, and how we kind of got here is that our expertise in doing those types of value-add transactions were necessary when cannabis-use properties became an opportunity out there for an asset class. So we used our expertise, and we were one of the first, if not the first, dedicated lender solely dedicated to the cannabis space. And so we've pivoted to that in 2016. And how we got there is we used to get our investors 11, 12%, and those yields started compressing from 2014 to 2016 from 11, 12% down to 8, 9%. But more importantly, the loan to values went up from the industry norms of 60 to 65% to 70, 75, 80, and 90% on purchases. And there was no change in the quality of the sponsor of the properties. And so we were not interested in continuing to push capital out, and we were just watching things shake out. And during that time in 2014, our local Congressman Dana Rohrabacher passed the Rohrabacher-Blumenauer Amendment, which is the most significant cannabis amendment that has ever been passed by Congress to date. And most people have no idea it exists. And that is that this amendment defunded the Department of Justice from prosecuting any cannabis-related business in a medically licensed state. So no matter what administration is in power, Congress has used the power of the purse to defund the Department of Justice or the executive branch from any prosecution. So once that was in place, we felt comfortable originating to the owners of commercial properties and allowing for cannabis use tenants, and not having a concern that the tenant could be prosecuted and cause that transaction to become distressed because the borrower's having to replace the tenant. So we pivoted in 2016. We launched our fund in 2018, and then we converted to a mortgage REIT in 2020. As of today, we've done more transactions than any lender in the country. We were the first fully dedicated lender to the space nationally. And, it's been an interesting, fun ride. So happy to get into it and answer more detailed questions.
Let me just talk about a couple of words that you use, a bridge loan and REIT. Those kind of specific to the industry. So a real estate investment trust is what you guys have, and you're kind of using these bridge loans. Can you explain to me, explain to the audience rather, what that REIT is, why it's important, and more importantly, why a bridge loan is important for the industry, a mezzanine loan or whatever you want to call it? What is the point of that? Why is that important? And what difficulty do cannabis business owners have in trying to find bridge loans and REITs like yours?
Yeah. So first of all, when we use the word REIT, we are not a traditional REIT. Traditional REITs own the real estate. That would be an IPR or something like that, or treehouse. We are a lender, so we are a mortgage REIT. So basically for us, we just get the tax advantage for our investors as traditional REITs. So that's the only difference there is we're still a lender. We don't own properties. On bridge lending, our capital is a different type of capital to build and stabilize these properties. Because we have to move quickly to close these transactions, we have to underwrite the budgets on as-is and fully stabilized values. We have to do feasibility reviews on the budgets in advance. And then we have to continue working post-close. Typically 50 to 100 draws per transaction are processed. And so that is a different price loan. It's a much more expensive loan because there's a lot more going on. Once you fully stabilize that property, you built it and stabilized it, you're going to refinance out of that short bridge term loan, bridge meaning short, into a lower cost, fully stabilized loan, because now you've got a tenant that is actually generating cash flow. And now that qualifies for more of the traditional loans.
Mm-hmm. So, when looking at opportunities, is this more for emerging markets that are trying to get licenses and facilities, or are you also working kind of in the same way that IIPR is with sale leaseback options? Are you looking at West Coast, East Coast? How does that work?
Sure. So as a lender, we're agnostic for the most part of any of the 36 or so states out there that are currently licensed. So what we're more focused on is looking for the most experienced operators with the strongest sponsors and the best properties across the nation. So we are looking for those primary elements. And then we built our own first proprietary database in the entire industry to understand what the metrics are and use data to make the decisions when we want to underwrite a transaction in one of the various states out there. So that's how we're looking at it.
Where's the hot market at with real estate kind of all over the place? And we're seeing maybe some bubble sectors like malls, to me, look crazy as they're defaulting and no one's really shopping at a mall, whereas cannabis is hot. But either way you look at it, it seems like commercial real estate is at an all-time high. And I'm wondering if it's going to stay there. But tell me where the hot market is and how long it's going to stay hot.
So this specialty asset class is very, very difficult to originate, even for a lender that is very steeped in knowing how to originate transactions. Once you start moving into this specialty use asset class, you have to understand the licensing and how that affects the property value and how it affects the tenant. And you need to understand all the issues that come along with that, title insurance, property insurance. And how do you originate a transaction with a vehicle where your primary vehicle of capital that you're deploying states that the manager cannot do anything that's federally or federally illegal. And even though we are only lending to the owners of properties, a lot of people might think that we're operating in the illegal side of the business, which we're not. So you've got to think your way through of how do you delineate and how do you keep that credit policy clearly separating the owner of the property from the tenant, and even if it's owner user. So I don't want to get into too much of the detail of how we do that, but we had a very clear thought process of how that was developed. We developed it, our underwriting credit policy with Sidus Asset Management, one of the world's premier underwriters that's done $7 trillion for the likes of Oaktree and BlackRock. And that's kind of how we've been building and aggregating this. From 2,000 transactions that we've analyzed, we've closed 50.
Wow. That's amazing. And out of those, how many are plant touching? Are these producers and processor retailers, or is it just ancillary?
So virtually all of our transactions at some point will be plant touching for the operators, not the owner. Virtually all of our transactions are very large budgets. And that's typically going to be at least have some portion. Generally, the largest portion will be indoor cultivation. And then you might have some additional licenses along with that, as extraction, distribution or whatever. The least that we have is dispensaries, because those seem to be the easiest to underwrite and the least ratio of budget as a percentage of the loan to the purchase price or the value of the property. And so those are the easiest for our competitors to do those types of transactions. And it doesn't really need to process 50 to 100 draws for those transactions. You might have a budget of $500,000 or $1 million relative to our budgets are $5 million, $10 million, $15 million.
You've done $175 million since 2010. You mentioned Poseidon Asset Management as an underwriter. How many other folks does it take to get involved for this process?
Sure. So our credit policy was written with Citus Asset Management. I thought you might have said Poseidon. Poseidon is one of our cannabis equity funds. I just want to decouple that if that's what I heard. If
yeah, you did. Thank you for clarifying.
Yeah. And very well respected peer, but they're on the cannabis operator. They're providing equity to cannabis operators and not associated with Citus. But I'm sorry, what was your question again?
So I was curious about, with Citus as the underwriter, who else is involved in order for you to get to 175 million in lending in the last 11 years? That's a lot. So what is involved with that? Who do you have to work with? How does it work?
Sure. So Citus is not the underwriter. They're who we co-developed our credit policy with. We are still the underwriter. We still do everything internally ourselves. And, it was a huge, enormous challenge to deploy. It's now about 177 million over 50 transactions since 2016. When we started, it was very difficult to allocate the capital. Even once we had underwritten and understood the space, it was really difficult to build sources of capital. We would have to syndicate transactions originally until we raised our fund in 2018. Once we got the fund up and running, it became slightly easier. But now that the fund is in excess of 100 million and 3 years of audited financials, now we've got a dedicated vehicle, and that dedicated vehicle funds all of our transactions. We don't syndicate transactions anymore. So it's a very streamlined, clean process now.
Okay. So with you mentioned IIPR earlier, a real estate investment trust that does some sale leaseback options. You guys are actually, you don't wait for that. You guys are going to help people to acquire and build out cannabis properties. Is that right?
Correct. So this is the first asset class in the nation that even if the property exists, it's not built out yet for cannabis use. And it has to be built out and certified by the state and the city, the local municipality, to be cannabis use. And so IIPR and other REITs have traditionally focused on fully stabilized transactions that have a tenant that's producing. And so somebody still has to build those properties. And so it's more difficult, or you're not going to get as good of a deal with IIPR or some of these other, if your facility isn't stabilized and cash flowing. So you want to build your facility, get it up and stabilized. And you may or may not want to have a 25-year lease or whatever their terms are with escalators built in when you're not sure where the market is going to go over the next 25 years. So this is just a different option, and it may not even be an option to get on IIPRs or tree houses or any of these other traditional REITs. That's a farther down the road stage of the process. They're one of the potential exit strategies for us. So our transactions, of the 50 transactions, almost half of those have been paid off already by primarily other private lenders or state or federal credit union, or I'm sorry, state banks or credit unions, or they could be with a REIT, a traditional REIT such as IIPR. So those are the three primary channels of our transactions being paid off.
Okay. How much of distressed assets are you looking at? I'm curious with the massive amount of building that's going on, especially up in Canada between Aurora and Canopy. It seems like they have produced a lot of buildings that maybe they don't need. And I'm curious if there's an opportunity for new entrants to come in, whether it's West Coast or the East Coast, to look at distressed assets. Is that something that your clients are looking at? Are they looking for value or just to get in at any cost?
If we were to lend in the Canadian market, we only lend in the US market, we would be the expert. We would be the exact lender that you would want to use if you wanted to acquire a distressed asset, one that was partially built. Especially, it's a very difficult process to go midstream on a transaction. So we would be that type of lender. The Canadian market and the US market are two totally separate markets. Canadian had no experience, and they went big and built these enormous facilities and had no idea if they would work or not. Nobody had ever built a 1 million square foot facility previously. As opposed to in the United States market, there was no huge amounts of capital as the industry was growing. And so all these transactions were basically the capital was raised either directly by the operators themselves, or what debt was available was very small amounts that were coming from private lenders that were very, really analyzing these transactions before they were letting the money out the door to build these facilities. So I think the U.S. market is much more controlled and less of a distress situation, and I just don't see the distress market coming through yet on the build or on the facilities. Maybe over time in 3 years or 24 months, maybe there might be some operators that fail. But even if an operator fails, the real estate, which is what our collateral, you can replace that tenant. So we have a different perspective than an operator where it might be overbuilt or something like that. So, and by the way, we do analyze what the current market capacities for each license state, for each license type in each state. So we know, have we reached market capacity? And nobody else has looked at that. We were the first ones here. There was no data to pull. So we had to build our own databases to extrapolate that information for underwriting.
Is there anywhere that you don't want to do business? It seems to me that Oklahoma is overbuilt. I'll put that in air quotes. With 7,500 licenses, it's twice that of Oregon. I personally am a little nervous for the market there. Is there anywhere that you're just like, nah, we're not going to do business there?
So it's different from an operator side, from a lender's side. So California, which is the largest market under one type of license compliance, or in Oklahoma, to a lender, that's a very easily replaceable tenant. So in that aspect, those are markets that we feel more comfortable in, as opposed to, and we're analyzing each of these things with our database and our underwriting criteria, but as opposed to a limited license state like Florida with 22 licenses or so, and it has to be fully vertically integrated, that for an operator might be great, but for a lender, there's not that. If I was to foreclose on a transaction in Florida and I had to replace that tenant, do you think it's going to be easy to replace that whole tenant for the vertical capacity, the entire vertically integrated asset base? Or do you think that the other 21 license holders are just going to expand their capacity and absorb what the production was for there? So the lender looks at it differently. We want to be able to easily replace tenants, whereas an operator wants a limited license and protected market.
Mm-hmm. With your clients looking at an 18% annualized internal rate of return, you're able to kind of look at opportunities, whether they're good or bad, and you guys are figuring all of that out. Seems to me like you guys are on point with at least 1% per month, which is phenomenal. How are you guys doing that?
There's a couple of aspects that get those outsized returns for our investors. The first aspect is because we're a bridge lender, we're charging more for our high performance capital. We have publicly traded companies that come to us that could go and get more institutional priced rates at 6%, and they're borrowing from us in the mid double digits. And you might ask, why would they do that? And it's simply because these facilities do 10 to 15 times more revenue per month than a traditional non-cannabis. And how that equates is that our borrowers are doing $1 million to $5 million a month in revenue. And so every month that we can save them in the build time to get that facility up and operating equates to millions of dollars. And so we typically save at least 20% and some as much as 50% if it's a lower cost rate. And that might be as much as $30 million if it was 6 months and $5 million a month. And so in that particular transaction, why would you try to get a 6% rate when it's going to cost you lost $30 million in operational income from the facility? So that's why everybody comes to us. And we have a 100% closing ratio.
Wow. Okay. Are you nervous at all about the MORE Act or the federal legalization at all? With banking coming in, it seems like SBA and other banks would be competing against you. What is your plan to pivot to stay relevant with the eventuality that banking becomes a thing?
Well, we welcome that, and we're actually tracking all the banks. So we know that there's already banks lending directly, anywhere from LIBOR plus 300 to LIBOR plus 450. So there's a big misnomer that there's 695 banks that are doing depositor for tier one plant touching. And of those 695 banks, there's probably 5 to 10% of those that are actually lending directly. So the fact that everybody thinks there's no lending or banking is just completely off the grid, or off the, is absurd. We've never seen in one of our borrowers, if one of our borrowers came to us and didn't have banking, we would be like, there's a big problem here. They all have banking. It's already in place. And so if a bank wants to go into this, regardless of the MORE Act and the SAFE Act or the States Act, whatever it is, they still have to build the compliance department to board those deposits. And that's the part that these banks haven't done. And they have to get their existing depositors and their board to agree to be in a SIN business, or it's perceived as a SIN business. So I don't see that much of it changing. What I do see changing, if that happens, is probably you would be able to get past, you would have the credit card transactions happen, which would eliminate the cash buildup at the dispensary. So that's where the cash builds up. But all the transactions between cannabis-related businesses do not happen in cash. Just the dispensaries are bringing the cash back from that level of the sale. Our bank is actually able to utilize debit cards now, so they're working past that, and I just don't see that being an issue for us. If a bank wants to be in right now, they can go ahead and be a depositor, a bank, or they could be a lender if they feel comfortable in that space. So, and on top of that, the banks don't do bridge lending and cannot process draws like we do. So it's never going to be a competitor to us. And we specifically picked that lane and made a conscious decision to do that when we were analyzing the space in 2014 to 2016.
Mm-hmm. With the current political landscape the way it is, we saw a huge spike in speculation after the election. Everyone thought that legalization would happen. I'm curious what you anticipate since January. Kind of the cannabis stocks have since corrected significantly, and so curious about what you plan on, or where you guys are thinking politically, where things might be headed, whether that's federal legalization. The MORE Act had its fifth time in the House, I think, last week. So there's more happening all of the time, and I'm wondering how you guys are preparing for that.
I'm less bullish than my peers. I believe that if the Biden administration wanted to send a message to this sector, they would have reinstated the Cole memo day one. Doesn't take an act of Congress. They could have easily done that. That would have signaled to the entire industry. So I knew immediately that they weren't headed that way. And I don't know why people didn't pick up on that. It's the simplest thing they could have done. The House is no big deal. You're going to always pass anything through committee or the floor. So I wouldn't focus over there. That's kind of just a given. It's the Senate that you got to get it through. And to get 60 senators to break the filibuster is going to be enormously challenging when you've got both parties kind of at such odds against each other. And I try to break these two things apart, which most people don't think about it until I say it. There's two things happening. The political capital is behind decriminalization, but for businesses, it's legalization. So decriminalization is more for people. Legalization is for companies. And so the big push of the political capital, and that's what drives Congress, is decriminalization. I don't see that reaching over to the side of legalization or deconflicting from federal policy in the near term. And the reason for that is that, first of all, we're coming up into the midterms fairly shortly here. There's not enough senators that the Republicans would vote with the Democrats to pass this. And on top of all this, everybody tries to make the bills broader and broader and broader. And the more broader you make it, the less that you can get a consensus of everybody. If I was to be, if you and I were lobbyists here and trying to push something through, I would focus on these two narrow things. I'd focus on the credit cards, and I'd focus on 280E. You could it takes Congress to get 280E implemented, and it could follow the state's rules there. And now you've got a situation where you just increased the EBITDA, the net EBITDA of all these companies across the nation. And if you could also, and the other one I would focus on as credit cards, because then you eliminate the buildup of cash. Those are so narrow and easy to do that I would start there. And I think you just need to chip away at these things. The broader you make it, the harder it's going to be. But you can't get any of these things done without criminal reform, because that's where the political capital is. And there's be careful what you wish for. The more that you continue to make it legal, the less chances that you're going to be able to continue to collect your taxes, because it becomes instead of being illegal, it's a code violation for the property. And so we've got dispensaries in Los Angeles where you cannot tell one from the other, that one's licensed and one's not. And it's not a crime for somebody to buy there. They don't know. The products look the same. And so one guy's having to pay taxes and the other guy's not, and he's doing everything right. And so that if you continue to decriminalize it, you're going to continue to have this disparity between how do you enforce this. And that's a difficult issue.
Mm-hmm. Will we see a change in the House and Senate midterms? Wondering if not enough change is happening fast enough, and if the Democrats will lose the House and Senate, and what that means for a cannabis industry in the second half of the administration's time.
So this is back to just my personal prognostication. Many of my friends and even relatives have said that they feel that the Democrat Party has left them. And I think that the Democrats, because they got both the House and the Senate and the executive branch narrowly, that they don't know how long they're going to have this power. Right. And so instead of trying to work with Republicans and to come to a consensus, they just went all out. And the Democrat Party has a wide range of factions at this point. And the one that is the most verbal or, pushing things is one of the more extreme in traditional Democrats' eyes. Depending on where you're at, maybe you're in that camp or not. But the issue is that you've got a more narrow band of the Democratic Party pushing so hard that I think that you're going to start losing Democrats in the more conservative areas of the country. And so I believe that they're probably going to lose power from the next election cycle, or continue to lose states or representatives in the House. And as we get to the Senate, there's a lot of different senators that are coming up that are retiring or things replacing. But if you were to eliminate that aspect, if it was just apples to apples, I think that the Democrats might lose power, because they went and overreached so far without trying to get a consensus from the Republican side. Now, I'm happy that they're trying to go as far as they possibly can, but it's difficult if you don't have. If you're going to lose power after you went that direction, you better be sure you've got it. You can get those bills through. Mm-hmm. I don't think they can. I mean, you're going to have to do it through budget reconciliation.
What about the taxes that's going to happen? I mean, this isn't a tax podcast, but there's a lot of stuff happening in politics, and a lot of that is impacting the cannabis industry. And I'm wondering about either your personal opinion or otherwise about the potential for capital gains. So if they remove a 1031 exchange, what will that do to the industry? What will it do to the industry if they increase short-term and long-term capital gains? There's a lot of speculation in housing and commercial properties, but the savvy ones are going to take a look at these cap gain increases, the short term, the 1031, and maybe rethink what they're doing. Is that something that you're already hearing about? How is that going to impact the industry?
You and I look like we've been probably through a few presidential administrations. And so I think that we're old enough to know that this is just their opening volley. I think that every administration, when they talk about tax policy or where they're going to go, they set out that bookend so far out that they leave, lots and lots and lots of room to negotiate in there. So I don't think that those things are going to get through. I don't think that we're going to have to worry about that. I think there might be some meeting in the middle there, but I can't imagine that the things that they're talking about, that they're going to get all of those items. Capital gains, limited 1031 exchange. I just don't see it there. You would lose your own party if you did that. So that's just my personal opinion. We'll see where I think there's somewhere in the middle, maybe not from the middle of that bookend, maybe closer to one side or the other, but I don't see that happening. But regarding taxes in general, I don't see a complete federal legalization that is non-limited in some way, because if you and I are the senators from California, why would we allow a complete federal legalization when now this interstate commerce clause allows any product to be brought in from any other state? And there's other states with lower capex and opex basis and lower taxes that could import into California, vice versa. And so I just don't see that happening. So I think that no matter what way it goes, it'll be most likely deconflicted from federal policy so that those barriers can still maintain in between the individual states, however they do it.
Do you see anybody racing to complete transactions to avoid the elimination of those tax benefits? Is there anybody making these decisions now in the eventuality that that could happen?
If I was a CEO of a cannabis operator, that would not be, I would be more making my business decisions on growth, cash flows, and how we want to position. That would not be one of my considerations. I don't think that if you're betting on politics, it's work on the things that are the known. At this point, I wouldn't be factored that in. If it had passed the House and the Senate, committee votes, and both floor votes had passed and they were reconciling it. At that point, I'd put the gas on and be looking at that.
Mm-hmm. What are you looking at? Are you advising anybody to be looking at anything in particular? What is your advice right now in a world of uncertainty?
So for us, we try to take that speculation out. We are not, we're not trying to make predictions on the operators. We're just looking and underwriting data. We're not making projections on who's going to be the top one in the nation. We're looking at who has the most experience. We're looking for the strongest sponsors, and we only value the real estate, the value of the real estate. We do not book in the value of the tenant, business value, or their licenses or things like that. So we've eliminated that speculation. We're only looking at the value of that property, and then we have protective equity and personal guarantees and all those things. So we've tried to make an approach where people could enter this sector of cannabis, have some exposure to cannabis, but de-risk it as much as possible and get monthly distributions with cash flow. And then we do have some upside from some of these transactions. We do have some equity kickers in some of them as well.
What is your crystal ball prediction? Where you seeing the market heading in like 3 to 5 years?
So because we can't to try to guess where government is going to go what you don't want to do is that. So what we've done is try to develop a strategy where we don't, no matter which way things go, we're protected. And so we keep all of our loan terms very short, about 18 months on average. And so that each transaction is being originated in the most current value or market set of what's ever happening, whether it's federal or state or local, or whatever it might be. And then in addition to that each time we come to a loan term, we can reevaluate if we are willing to extend that transaction, has new information developed that we might not be willing to extend this transaction, or we're going to put in new covenants or require a principal reduction to extend it. So I'm not in the business of making that guess. I think that it's going to continue to grow. It's a $50 billion asset class right now from the 36 states that we're looking at. So it's enormous, but that's just the real estate side. I continue to see it grow. I think that the morality of everybody being favorable to it continues to improve. I do think we'll get to some deconfliction, but I think it's going to be closer to 36 to 60 months. So I think it's going to be a lot farther out than most people do. I just don't know if this administration has the political will to push it through. I do believe Biden would sign it if it came through, but I also believe that the last president, I don't think that any president wants to go against that right now if it goes through House and the Senate.
Mm-hmm. Interesting. What is the future for Polaris Equity Group? Are you guys going to maybe file an IPO and compete against IIPR in some way, or?
Yeah, we believe that the best strategy is just to remain private. We were asked to go public many times, and we believe that our strategy is really good by not having any volatility of our share price. And so we might be doing really, really well if we're public, but if the market becomes to have fluctuations in volatility, that could affect our ability to raise capital and put us under pressure that we might not be able to raise money to fund additional transactions. So we don't want that strategy. This particular asset class, it does better in market volatility, a real estate downturn or a market cycle, economic market cycle. And so we want to be able to have our investors feel comfortable that we can go right through any of those events and not have those issues that are extraordinary pressures.
Okay. And did you have any advice for people looking to get into the industry? Would you tell them to go to Oklahoma as a new emerging market? Would you tell them to go to Oregon for distressed assets? Would you tell them to go to be a producer or processor or retailer? Where would you send somebody who's like, I want to get into the cannabis space?
You know, it requires so much capital for an individual or a small team to ramp up their capital to go into this. I would be trying to bet on states that are still yet to emerge, because it's a fair playing field from day one. And so I would generally try to work in your own local market. You have more political power or knowledge, hopefully, in that area. So, you know, if your state is contemplating going cannabis friendly, I would be trying to speculate on what properties are potentially going to fall into the areas that would be acquisition targets, and I would go put those under option to purchase. Very little amount of capital necessary to do that. I would make that purchase contract for purchase and or signs. Now you've got an upside. You never even have to close on the transaction. So that's probably where I would go, or maybe where we go, or what we would do if we were in the space. So those are the easy targets. Once this estate has been gone cannabis friendly, you're competing against people that are got so much more capital than you. And if it's somebody that already has a lot of capital, then they wouldn't be asking this question. They've already done the metrics and are looking for them. What's the best fit for their growth?
What would you say to somebody who's trying to get into the industry to compete against you? BlackRock, somebody big, or just like a smaller version of the Polaris Equity Group? Do you have any words of wisdom or cautionary tales?
Well, BlackRock did look at the space with us. And so we've talked to them, and we talked to them a couple of years ago. And they're in the space already. There's many institutions, and we're tracking these people already. To get into the space of lending, you got to decide, are you a value add lender? And if you are, do you have the expertise to move into the space? It's difficult to go raise capital or to close your first transaction and tell your investors that you're now an expert in this sector. So you got to kind of work your way up. Or if I was entering the space, and the way our approach was, we started very small, loans in the $1 million range. And we've worked our way up to loans in the $20 million range over 4 years, and looking at 2,000 transactions and building our own proprietary databases. We built all the information that was necessary for us to understand the market and to make those decisions. As somebody that's emerging into it, it's difficult to know if you're making the right choice, because you don't have that data. There's no other third parties to pull that information from. So I don't know. My best would be just to start small and work your way up, and figure it out as you go. That's probably what I'd say.
It's good advice. Do you foresee seeing negative rates? How would that impact the industry because rates right now are at an all-time low, but prices are at an all-time high. So, your payments are kind of about the same. But what happens with negative interest rates that we've seen, in Europe and other places? Do you foresee that at all happening?
So I think that you're talking about the prime lending rate for the United States. And in that aspect, that only applies to commercial lender, or I should say institutional lenders, because they're borrowing. They're banks that are borrowing. As a private lender, we don't borrow our money from the federal government, so it has no impact. So that would only affect those loans that are with the credit unions or state banks that are using some index, LIBOR or prime, as their lending. And if it's a loan that is not fixed, you're going to have to look at what's going to happen with my rate. I do think that we are going to see some inflation. I do think that the rate will start to creep up over time. But for us, that doesn't matter to us.
What about the inflation? They're calling it transitory. Is it here to stay?
I was just wondering when any inflation is non-transitory. I think anything is transitory given enough perspective of time. So just don't really understand why they're focusing on that. Are we talking transitory for an administration or for a year or what? I think anybody that's out in the regular world is experiencing significant inflation, whether it's there or whether the government says it's there or not. But I do see that happening. I think that'll artificially continue to pull up all real estate markets because, in effect, what's happening is the dollar is becoming worth less. And so that property value is actually increasing in amount of dollars, but in the net purchase value of those dollars is still the same. So it's a false premise that those values are necessarily going up. And I think in the traditional real estate market across all assets that people are going to be more insulated and protected because of that. And that'll extend the possibility or how long in the tooth this real estate cycle is.
Mm-hmm. And having said that, I threw a lot of doom and gloom scenarios at you. Are you still positive, optimistic? How is your outlook for the cannabis real estate industry? Is it positive, negative? Is it scary? What's your take?
I think it's very positive. This asset class is most similar to cold storage data centers or lab space, and it's a very unique type of sector. So things that you group in with real estate do not apply as you get into more narrow or specialty asset classes. These tenants don't move. They're not looking for a lower rate somewhere else. Once they've built out their facility, they're not going to give that up to go to somewhere else. They would just expand and build another one and increase their capacity. So I think that this asset class is going to be enormous. Most of the transactions from a percentage have all been done out of equity. And so, it'll be nice as there's more lenders join the space. We expect them to come. We welcome them. We've competed against the most competitive market in the country on the West Coast. California has got probably the most lenders per capita in anywhere in the country. And so we've successfully been in that industry for 30 years, and we're very comfortable with how we do things that we can compete in this sector as well.
Mm-hmm. Well, we've covered a lot. I'm going to put your LinkedIn contacts and Pelorus Equity Fund's website in the show notes. I just want to know if there's anything. I mean, we covered a lot. Is there anything else that you want to throw in at this time?
I thought of one thing. So a lot of people are curious of how we get equity upside in a transaction when we're only lending to the owner of the property. And typically that'll only happen with an owner-user transaction. Owner-user means that those two parties, our borrower and the cannabis operator, are affiliated at the ownership level. And in those transactions, basically, we do not change our underwriting in any way for how we underwrite that property. But typically, if there's a transaction that is distressed for time, there's a purchase price that has to close and they need to move up in our priority of closing. Typically, the last thing that they can do is offer some equity in that transaction. So that might be options for warrants, or it might be equity day one. In either of those scenarios, that we are not having to have any risk in that transaction. We only exercise the option if we're in the money. And on the equity, we didn't have to give up anything other than moving the transaction in the priority of time. So in both of those scenarios, those equity positions are held at the manager level and then dispersed down as cash dollars to our investors as they're amortized in over the life of the loan.
And that's obviously flexible enough to where if you were in Washington State and Washington only allows 10% ownership from out of state, you would be flexible enough to figure out which state has caps on out of state ownership and all of that.
Yeah, we've got the most sophisticated attorneys in the country that have done the most transactions for all these that we utilize. So all of that is that our investors don't have to spend the time and money to do the due diligence and understand all those nuances, and we've got that figured out.
Beautiful. All right. I think with that, we're going to roll this one up. I want to thank my guest, Rob Sechrist. He is the co-founder and president of Pelorus Equity Group. I appreciate you being on the Talking Hedge.
Thanks, Josh. It's a pleasure.
I appreciate it. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out. Smash that like button on your way out and check out these other videos that we've got.